Hello Internet, my name is Ryan Ingram, author of Rental Property Insurance, an Investor's Guide to Insurance. You can get this book on Amazon or you could download it for free in the link below. If you download it for free, it will ask for your email address, but rest assured I will email you so infrequently that you're going to be both shocked, surprised, and really convinced to open it up if I ever do email you. So in the last video, we discussed the policy forms, basic, broad, and special. Right now, we're going to discuss the actual cash value and the replacement cost, or the lost settlement options. Now, this is easily the conversation that I have the most with both clients and prospective clients. Now, as I mentioned before, I currently own an insurance agency where we exclusively write insurance to other real estate investors. That's all we do. That's our niche that we focus on in the world that we live in. I am an investor. I've got around 60 doors of my own. So all of this I learned specifically to help both myself and other investors. Now, when we refer to loss settlement options, there are two main choices that we have: actual cash value and replacement cost. Let's first go over replacement cost. Now, what replacement cost is each insurance company, they have their own kind of calculator type deal. And what this calculator does is it takes the square footage, the number of stories, the roof type, it takes everything that it can possibly find about the house, and it calculates exactly how much it would cost to put all of those building materials back together as they are currently. When insurance people say replacement cost, they're not referring to how much you paid for the property. They're referring to how much it would cost to completely rebuild new construction to match all of the existing building materials on that property. So it's all of the materials plus labor equals replacement cost. Now, if you have an older home, let's say it's built before the 40s or 50s, then this calculator is going to assume that we're putting plaster back into the home. So if it's an older home, some companies might offer what they call a functional replacement cost, because in insurance policy, what it does in essence is it's a promise to restore your property to the exact condition it was in prior to that loss. So by sheer replacement cost, then that has to, inside of that promise, it's excluded that, hey, if you have plaster walls, we're going to give you more plaster walls. But if it's functional replacement costs, then it's more so, hey, we know you have walls, we're going to give you more walls, but they won't be made of the same material. They will be the modern equivalent of those walls. Now, if you are investing in a depressed market or just the Midwest, then all the investors here in the Midwest, we understand that you can buy a property for $50,000, $60,000. It's rent ready, it's beautiful, gorgeous, but it would still probably cost several $100,000 to build that property back to where it was. So not a lot of investors here in the Midwest actually carry replacement cost on their properties, because the first property that I bought, what led me to learn all of this, I purchased that duplex for $35,000 and the replacement cost came back to $307,000. That's a giant difference. Like insurance companies kind of call this a moral hazard, right? Because now the property is worth, to me, more burned down than it is standing. I could buy 10 duplexes if this one were to burn down. So a lot of insurance companies aren't necessarily comfortable with providing replacement cost on a property that was purchased at a severe discount. So the biggest takeaway about replacement cost is this is calculated by the building materials and the labor. It has nothing to do with how much you purchased the property for or how much the market value is. Similarly, actual cash value is the second replacement option. Now, actual cash value also has nothing to do with how much you paid for the property or how much you think the property is worth. So a lot of investors, including myself, when you first hear actual cash value, you think, oh yeah, that sounds great. Just insure it for $35,000 because that's how much I paid for it. Well, that's not exactly right. So the formula for actual cash value is replacement cost minus depreciation. Now, each insurance company is different in how they come up with the depreciation, but the general rule of thumb, which is just that, just a rule of thumb, is that depreciation is 1% per year up to 50 years or 50%. So in this scenario that I used with my duplex, let's say the replacement cost came in at $300,000. Well, that duplex was built in the year 1900. So we're going to max out those 50 years or that 50%. So the actual cash value of the property would come in around $150,000. Again, this has nothing to do with what I actually purchased the property for. At this point, a lot of investors here in the Midwest immediately say, okay, great, I would like just to go with actual cash value policy, because if the property were to burn down, then I wouldn't need the $300,000. I would be just comfortable and just fine with the actual cash value policy, which would be $150,000. Now, in the event of a total loss, you're correct. You would get either $150,000 or $300,000. But when you get an actual cash value policy, your largest exposure isn't in the total loss, because yes, of course, everyone is fine with getting a check for $150,000 on something that they only paid 30 grand for. But the largest exposure is truly in the partial loss. So not if the entire building burns down, but what if only part of the building burned down? Let's use a kitchen fire, for example, because kitchen fires are pretty common. So in a partial loss, let's say the kitchen fire causes $15,000 worth of damage. So in order to replace the walls, replace the appliances, replace the countertops, the flooring, all of that costs $15,000. Well, most likely what's going to happen on your actual cash value policy is it's going to be depreciated the same. So now you've got the $15,000 replacement cost. Let's use my building, for example, and let's say that it's built in the 1900s. So they're going to depreciate this amount by 50%. So now you're looking at $7,500. But you've also got your deductible. So I encourage a lot of people to get a $2,500 deductible. I think that's the sweet spot. If you go to $5,000, it doesn't really make that much of a discount. If you go to $1,000, it increases the price generally enough to make the $2,500 more appealing. So now you've got the $2,500 deductible. So in the event of a claim that cost $15,000 to fix, you would only get an insurance payout of $5,000. So you're only getting 33% of what you should be. Now, this comes down to risk tolerance, because I have investors that have, 70, 80 properties that prefer this type of policy because they do a lot of the work themselves. So they might be able to get away with buying all of the materials needed for $5,000 and then installing them themselves. Now, I have other investors that have 1 or 2 properties, don't do any of the work themselves, and this type of loss would be detrimental to their real estate investing, as they're just getting started and haven't necessarily built up enough cash flow or enough reserves to take care of this. So it's very important to understand this difference. This might be one of the largest things that you should either completely understand and have a grasp of, or not inside of your insurance policy. Now, a point of clarification that I would like to add is the depreciation can also be offset by the last time you made renovations. And this is company specific. You're most certainly going to have to seek clarification from your insurance agent on how that particular company is going to handle the depreciation if you have recently remodeled the property. So let's say in that scenario of the kitchen fire, let's say that you remodeled the kitchen 2 years ago. Well, now, in theory, you have a very strong argument to say, whoa, insurance company, this claim should not be adjusted by 50% depreciation. This is only 2 years old, this kitchen that was affected. It should only be depreciated by 2%, in which case, if your insurance company agrees to that, then actual cash value became a lot more attractive, because now you're paying actual cash value prices for essentially a replacement cost policy, because the depreciation is only going to be 2%, not 50%. A little over a year ago, we had a tornado come through Dayton. I had an investor, the roof was torn off of his property, but he just replaced the roof. So fortunately, the insurance company depreciated it by 3%, because he replaced it 2 years before the tornado, and they depreciated it 1.5% for 2 years. So he made out very well on that policy because this was a 3-unit, and he was only paying around $800 per year for that insurance policy, whereas a replacement cost policy on my 3-unit is about $1,400. So that's a really large annual savings without that much of a consequence. But again, that's an isolated incident, which again, I'm not your insurance agent. I don't know your specifics. You need to reach out to your insurance agent, seek clarification on the insurance company that you're with, and perhaps it might be a good deal to go with the actual cash value route. Thanks so much. Please don't forget that you can get a free copy of the ebook at reinsurancebook.com, and that is in the link below, as well as some incredibly beneficial handouts at insuredbyingram.com/download, also in the description below. And in the next episode, we're going to be talking about the coverage letters of your insurance policy. So thanks so much for watching, and can't wait to talk to you soon. Thanks.